What's up, guys? It's me here. And if there's one thing that scares investors more than anything, it's volatility. Whether it's rising interest rates, inflation, geopolitical conflicts, or the fear of missing out, the reality is these factors have the potential to shake up even the most seasoned investor. But that's why it's incredibly important to be aware of the hidden risks of market volatility, because chances are you could lose a lot of money without even realizing what's happening. That's why in this video, we're going to break down exactly how volatility works, how it impacts your portfolio, and what you could do about it to make money. Although, before we start, as usual, if you appreciate all the information, it would mean a lot to me if you inflated that like button or subscribe if you haven't done that already. So, thank you guys so much. Alright, so first, let's talk about what exactly is volatility and how does it work. Well, in the simplest terms, volatility just means the degree of fluctuation that an investment goes through over time. Like for instance, if you were to plot the price of Bitcoin over the last 10 years, you'll see wild swings in price to the upside and downside, whereas something like the S&P 500 tends to be relatively stable with less extreme moves. This is why, when people invest, they often look at the beta of a stock. In this case, the higher the beta, the more volatile the stock tends to be. Although, even though beta can give you a general idea of what to expect, there's also something called standard deviation, which is another way of measuring risk that takes into account how much the actual returns fluctuate from the average return. For example, if a stock has a high standard deviation with returns that are widely scattered, that's an indication that the stock price is more volatile and unpredictable, while a low standard deviation suggests that the stock price is more stable and consistent. But now that we understand the basics of volatility, let's talk about the hidden risks that most investors fail to realize. Because despite what you might think, there are several dangers that could cause serious issues for your portfolio. And the first one is panic selling. This is by far the most common mistake that every retail investor makes. And it usually happens when a stock starts to decline in value. People get scared, they panic, and they sell off their positions at the exact same time, which only makes the situation worse. For example, during the dot-com bubble, it was estimated that investors lost somewhere between $4 and $5 trillion by selling at the wrong time. On top of that, if you're invested in a mutual fund or an ETF, the shares that you own represent a portion of the entire fund's assets. So, when those underlying securities drop in value, it's entirely possible to lose money depending on when you buy and sell. Now, the second risk of volatility is the opportunity cost of holding too much cash. Even though cash is considered to be one of the safest investments that you could possibly make, it's actually losing value every single day due to inflation. And that's why it's not uncommon to hear stories of someone who sits on the sidelines waiting for the perfect time to invest, and they end up missing out on some of the biggest gains in stock market history. Take, for example, if you missed the last 10 best trading days in the S&P 500 over the last 20 years, your return drops from 6.8% to 3.9%, even though you still own the same amount of stock. Or, another way to look at it is during recessions, people tend to spend less and save more money. But if you keep too much cash on the sidelines, you're not only losing out to inflation, but you're also forfeiting the opportunity to invest that money elsewhere. And third, there's the capital gains tax. Whenever you sell an investment for a profit, you've got to pay taxes on that income. And depending on how well your portfolio has been doing, that could easily add up to tens of thousands of dollars. So now that we understand the hidden risks of investing, let's talk about what you could do to protect yourself. First, when it comes to losses, the best thing you could do is stay the course. Easier said than done. When everything is dropping in price, it's normal to feel a sense of fear and uncertainty about the future. However, studies show that the most successful investors are the ones who stay disciplined, keep buying consistently, and don't deviate from their long-term plan. Second, to mitigate the opportunity cost of holding too much cash, consider dollar cost averaging into the market. This means that instead of trying to time the market, you invest a fixed amount of money at regular intervals. That way, you're not worrying about whether or not you're buying high or low, and you're automatically taking advantage of any price movements. And third, when it comes to taxes, the easiest thing you could do is hold your investments for longer than a year. By doing so, you'll pay long-term capital gains taxes, which are significantly lower than your income tax rate. So with that said, you guys, thank you so much for watching. Also, make sure to add me on social media and to my second channel. I post there every single day, so make sure to add me there. Thank you so much for watching, and until next time.